All right, the next discussion, it's a talk show in fact, and the talk show with the topic Investors' Power of Retail. All right, and the moderator for this session is Mr. Puneet Gupta, Partner Transaction Services, Deloitte, India. Can we have Mr. Puneet Gupta on stage with a huge round of applause, ladies and gentlemen?
Good afternoon, everyone. Consumer and retail is a big market in India, almost about INR 70 trillion now. And from an investment perspective, this has always been one of the most preferred sectors for private equities. Very few, I mean, most of the private equities have consumer as one of their preferred sectors to invest in. If we talk about, say, last 2 years, the deal activity has only increased in this sector. Some of the large deals, if I mention, and some of the large groups like Reliance, Tata, Aditya Birla, they have been doing a lot of investments, acquisitions. So some of the big deals like last year, a lot of private equities invested in the Reliance retail business. Then Reliance Retail itself acquiring majority stake in Clovia, in Just Dial. They recently also acquired a stake in Dunzo. And then Tata Group acquiring Big Basket. Aditya Birla Group acquiring stakes in apparel brands like Sabyasachi, House of Masaba. A lot of other consumer and retail companies attracting investment from private equities like FirstCry.com, etc. And even from a public market perspective, some of the big IPOs we saw in last years, Burger King going public, Sapphire Foods, which is the franchisee of KFC and Pizza Hut in India, and then some IPOs lined up already in media like Joy Lucas, etc. So coming to our topic today, focusing on investment in the retail sector and the power of retail from an investor perspective, I will now sort of have some points, some interesting points for discussion with our esteemed speakers here. To start with Ms. Benu first. So just as an introduction, Ms. Benu is the head of Freeport Retail in India. And Freeport is a leading developer and operator of outlets across Europe. And they are now starting operations in India as well. For the benefit of the audience, the business model of Freeport is to take the larger area on lease from the mall owners and then subleasing it to retail stores. So first, Binu, if you can help audience understand what difference or what new solution will this Freeport get to the mall operators in India, and anything different for the retail store owners also.
Thank you so much, Puneet. And am I audible? Yeah. So thank you so much, Puneet, and for introducing Freeport for me. Freeport is, as you know, I've been talking about Freeport in all the sessions everywhere previously also. It is the first outlet mall chain that comes to India. Now, what is an outlet store? Outlet store where the season 1 and season -2 expresses itself. So far, India, leave aside any other, besides Indian chains, we have not seen any international organized mall chain to come to India. So we happen to be the first and we are the lucky ones. Coming to the thing that how it is going to change and disrupt the retail environment. Now, when you speak of power of retail, retail is the most powerful thing that has happened to the commercial development that has happened here, and mall comes to the next. Now, not every mall owner will have the power or the bandwidth to first acquire the land, build it up, and then wait for 9 years and then speak to any fund to come and invest in. So when a organized mall chain comes here, what we do is we take it for a longer lease period, say for 29 years or 25 years, with whatever is comfortable with the developer. So you become the practical owner of that place for 30 years. And then you sublease to the brand. The brand is at comfort. B, the developer is at comfort. 3, the investors who are going to, because the developer has to make the mall. He has to put in money. From where will he get money? Either he has to go to the bank or to the funds which are not stepping in for real estate. He has to go make strata sales. So how are these prime locations which are there with the developer be in a comfort zone with the investor, with the developer, with the brands? So this is a kind of solution which I feel that mall chains should come up, take up the retail, and then we can go forward.
Understood. Interesting. And what we have seen is, again, in India, some of the malls going dead, even in prime locations, I would say, again, no reason why. And some of the malls doing business like anything, attracting footfalls like anything, may not be at the prime of the location, but again, no reason. So,
Very true, Puneet. What is a mall? Mall is an aggregation of brands. So if you have the right brands for the catchment, the mall is going to do well. Now, next question arises, how do you get the right brands? So you have to make the brand successful, comfortable. So how is a brand comfortable? When he has the comfort that nobody is going to disturb me, I will do my job peacefully, and nobody is going to say that, abhi ye mujhe rental theek nahi hai. So these kind of comfort, if we are giving to the brand will stay there. So, typically in a leased mall, there is a single owner, and that single owner negotiates and he knows the importance of the brand. But when you have done strata sales, what happens is each owner is looking at it as an investment, and in his mind, he's developing a ROI for that small piece of shop. But if it is a big entire mall, the developer or the long lease owner like us, we will say, if the brand is required here, if I'm losing on rentals here, I will make it at a spot B. So that kind of thing doesn't happen if individually people are trying to lease out the mall. And there the mall loses, and good tenants don't come in.
Binu, another point is what we have observed in retail businesses is that various retail businesses by the Q3 of FY22, which is like October 2021 onwards, their revenue was almost back to pre-COVID levels. Q3 doing well, it's season also in India, Q4 doing well, but some of their costs were still low compared to the pre-COVID levels, especially store employee costs and rental costs. So store employee costs lower because of some headcount rationalization that they did. More we saw in restaurants, and also lower rental costs because of negotiations with the landlords, either in the form of revenue sharing or some other negotiation. So in a way, their profitability on a per store sort of basis, if we see the metrics or KPI, is in fact better post-COVID. Now, these lower costs may be sustainable in the long run, may not be sustainable in the long run. So can you specifically talk about your experience in last 2 years, prior to COVID, during COVID, and post-COVID, how you have seen the rentals? So first, your master lease with the mall owner, and then your sublease to the retail businesses. How that has sort of changed during this period?
Puneet, COVID has taught many lessons, and COVID is one learning experience which was never taught in any school. So I will say that it was something which came it as a surprise. This cash boxes stopped jingling. So that is the time wherein the mall developers, they stepped forward and they kind of supported the brands. And the brands stuck onto it. They needed that kind of support. So Q3, thankfully, they came to the 80 to 90%. I will not say 100%, 80 to 90% of the sales which has happened. But then, that time also, we came to know that there were certain things we were unnecessarily doing. So there was a lot of cost cutting and rationalization which happened. Now, how will we sustain it? That is a $1 million question, because when you start paying lower rentals, and again the rentals, when they come back, your cash flow gets affected. I see the pent-up demand would come somewhere will get plateaued, and when it will get plateaued, we will have to show year-on-year growth and come back to normal and normal kind of leases which were decided for. We have to come back to those normal rentals very soon. Otherwise, put yourself in the developer's shoes. He has to honor the bank loans. He has to take care of the mall and maintenance. So somewhere we have to now bridge that gap and come back to normalcy.
Okay, understood, Benu. Thanks. We hope to see the Freeport branded malls soon in India, I guess now.
Thank you so much. We are about to begin.
Okay. Moving on to you, Vikram. So we understand that Ivy Cap Ventures, the P fund invests mainly in startups. So talking about some of your consumer and retail companies investment like Purple, Clovia, lingerie, Bluestone jewelry, Biryani by Kilo, chain of restaurants, Bewakoof brands. What has been your experience with these retail companies' performance during COVID? Did you see anything common in terms of how they approached during COVID and post-COVID? And anything unique to any of the companies that went well? Have you seen any transformation in these retail companies post-COVID? And once you answer, then I'll pose a next point related to this from a sort of a commercial real estate market point of view.
So April of 2020, I think almost every retail company we'd invested in, their revenues were almost zero, right? So it's not because there was no demand, it was basically the supply chain was completely broken, right? So people were not able to go out, they were not able to deliver. So, I think things started coming back, I think in 4 to 6 months after that. And there were substantial changes at the macro level that we noticed. One was about the substantial shift that happened from offline to online. There's a lot of digital shift that happened, we saw around that time. The people who were not used to using their mobile phones to place orders, we saw our fathers and older generation actually learning how to place orders online. They would never thought that they would ever go online to place orders. So we saw that shift happening quite substantially in that time. Interestingly, there were different categories or different product areas actually behaved differently. Of course, there were essentials. Essentials were obviously, allowed by the government to be delivered, etc. So those businesses who were delivering essentials, food, other things related to medicines and things like those, they came back very fast. But interestingly, things like jewelry, which actually a very interesting example in our portfolio, Bluestone, which has actually started as a online first brand. In fact, when we first invested in them in 2015, the whole argument was that you can create a jewelry brand without actually creating any offline stores, which was actually a very, very bold claim to make. But I think we still invested in it at that time, knowing that it's a different approach to market, but at some point you will have to bring the offline component to it. And interestingly, from 2020 to 2021, you would notice that the entire jewelry sector shrunk, by almost about 10%. The industry actually shrunk because it was not an essential buy, and the number of people attending weddings or the numbers were restricted. So, there were hardly any get-togethers, so people were not wearing jewelries anyways. But there was a substantial shift from offline to online. So if you were actually an online-first brand, this was a very interesting area to test whether your business has gone down or gone up. And we were amazingly surprised that Bluestone sales went up substantially, only because people shifted from offline to actually going to online and buying jewelry. So that actually gave us the whole idea of this, how this entire shift is actually playing out, even in product categories like jewelry. And of course, it was only in the middle of that when Bluestone actually decided to launch a a series of stores because, that was the perfect timing, to actually then create that visibility and actually capture the value of the offline online. They are very close to 100 stores now. And they're now very close to an IPO size. They're actually going for an IPO very soon. And had a substantial growth and achieved the profitability during this time. So something which it sounds counterintuitive for a product category like this, but this concept you will see would have applied to different product categories. People who were able to benefit from this entire offline to online shift, people who were able to leverage the use of technology very well. So all these brands that you mentioned that we invested in, we saw huge improvement in actually their sales numbers and even profitability. Actually, profitability went up. We believe that, and of course, that had an impact on the valuations in the space. In fact, valuations have gone up. We've actually looked at macro pictures and, we are a Series A investor. We write a check of about 30 to 40 crores as a first check. And then we follow that up with another 100 crores kind of investments. We manage about $500 million of total assets. And, what we realize is that retail as a sector, and when it comes to offline, online mix, is still, even the markets have come down, the valuations are still on the higher side. From Series A perspective, and even the later on valuations are definitely higher. But Series A valuation is what we look for. So we actually see that, even though the valuation expectations are coming down, but they're still on the higher side. So I think maybe next 1 year, we'll see some, softening of these valuations, primarily because, you will see that now, you're getting more clarity on, how things are evolving and how people who actually really got benefited from this, they've actually done very well, and they probably may be able to claim the right valuations. But people who have not been able to really go through this entire period of COVID, they've been sifted out of the whole thing. So that's the bigger picture of, what's happening.
Okay. Vikram, another thing is that, as you rightly said, most of these brands have omni-channel distribution model, which is offline sales as well as online sales. So in this digital age now, where do you see the business moving in all these brands? As in, will the offline share or the offline stores, they will remain at the same level? Will their share come down or will they grow? How do you see the business moving in this? And also, if we can talk about how do offline stores attract the customers versus online model?
So, one fundamental thing that has happened is because there's technology getting deep into this whole sector, there's a whole play of data, right? So I think, we all know that every time you use Google, every time you do a Google search, and if you're actually logged in with your Google Gmail account, Google knows everything about you, right? So there's a data points being captured every time you press any button, right?
Correct.
So there is a lot of data capture which is happening. So there are brands which actually have made this claim that they don't need to go offline. Purple is a very interesting example where both Arpit and IVCap, Bloom and IVCap are actually co-investors. Never went offline, never opened a store.
Not even till date?
So they tried with one store as an example of, just testing it out in Mumbai. They just opened one store just to see how it works. But that was just a pilot they did for a very short period of time, but they've decided not to go offline, right?
Which is slightly different from Nykaa model. They also started off online, but now have big offline stores in malls.
Correct. Now, Bluestone, I already gave the example, but I think Bewakoof is actually purely online business, right? So they don't have any offline stores. But, it's about what target audience you're going after. Now, Bewakoof is going after young generation, right? So the less than 30 years of age, that audience is actually on their mobile phones all the time. So you know that as long as you cater to that audience through their mobile phones, you we captured that market. It's not an easy business to go online, the offline setting up stores, etc. It requires, some capital commitment, etc. And then you need to build a separate set of teams, etc. So it's a fundamental call you have to take. Nykaa, on the other hand, built a inventory-led model right from the beginning.
Yeah.
Purple, on the other hand, built a very technology-focused, consumer, pull-driven model right from the beginning. So it's about the mindset right from the beginning. What kind of business model you want to build over time, right? So that's the people have done successfully on both the sides. There's offline only, there is omni-channel, and then there is online only. And we've seen, there are examples of successes in all the three.
Correct. Just that the mix of offline will be interesting for the commercial, retail, real estate market. It may have an impact on the same. Positive, negative, in future will tell. Okay,
Correct.
Thanks a lot. Moving on to you, Arpit. So you're part of the investment team at Bloom Ventures. Just a quick introduction, Bloom Ventures also invests in startups. So if my understanding is correct, you have almost like backed till date 150 plus startups.
Yeah.
Will have about $350 to $400 million assets under management.
Yeah, crossing 500 recently.
Okay.
Yeah.
So you would have even more number of companies to compare and talk about in the retail sector. Specifically talking about your portfolio in the consumer and tech space, Bloom invested in Cashify, the refurbished phone seller, buy and sell, Servify, which provides the insurance solution to the customers, Spinny, the second-hand car dealer, Milk Basket, even Purple, along with Ivy Cap, and some other investments like Love Local, SnapBiz, which is the retail POS business. So can you talk about some of the common achievements, challenges, and future prospects of these companies that you would have noted in the last few months of how the business unfolded?
So one important thing that across all kind of times, not just COVID times, you will realize that entrepreneurs face trouble all the time, and entrepreneurs will always be given no as an answer more often than anyone would like. At the same time, entrepreneurs, when they dig their heels and they work really hard, they are able to come out on top. Just look at example of Spinny. Spinny is a company which does used car retailing. It is an offline brand. It works with a lot of malls across the country. They now have more than 30 outlets. And these outlets are all, of course, offline because car typically have not been sold without doing a test ride. So e-commerce does not work there. And naturally during COVID, they had a tough time because the malls were not open. But what really happened during that time was that this company consolidated, built a lot of technology that as soon as they could open wherever they could open, they came back with a vengeance. And we realized that within about 3 or 4 months after lockdowns were lifted, they were back to their numbers. There is another company in our portfolio called Intercity, which is into intercity mobility. They run a brand called Smart Bus. They have more than 200 buses right now on their network across India. Similar situation because COVID had really put a stop on their business and they quickly came back. One important thing we realized is that in the post-COVID era, I don't think we are post-COVID yet, but suppose this was after the 3 waves, is a strong preference towards anyone who can offer a significantly better safe experience. So a brand like a Smart Bus or a Spinny is more preferred because people have more trust on them and they think that, okay, they will feel safer from COVID perspective to interact with them, which is definitely a positive thing. Overall, several companies have tried multiple different methods. Of course, Vikram has talked about Purple. One important thing about Purple also has been that they have only recently managed to raise a lot of capital, but for a brief while, they were working with very limited amount of capital, almost working towards break even, which is, and still growing very, very fast. So entrepreneurs will work according to multiple constraints and will still come out on top. So I think the story about every portfolio, every company, and every entrepreneur here in the audience is very similar. That if you put me under constraints, I will create new ways of solving them and I will come out on top.
Understood. Interesting. Uh, Arpit, from an investment perspective, what has changed from a piece approach point of view, or the things that you would see for your investment in these type of companies, in consumer and retail companies, prior to COVID and post-COVID as they are seeing the recovery? Can you talk about that?
So very clearly, you will notice that people who have stronger focus on economics have a higher chance of winning. One. Two, people who have a lot longer ability to make their cash run. For example, so it's very similar to having stronger economics are likely to win better. Similarly, people who are able to be lot more agile, pivot their businesses. For example, companies like Milkbasket and Dunzo had a big upswing, and companies like Spinny and Intercity had a big downswing. Can they pivot the business and do something which is a lot more interesting, keep their lights on, is also a very important piece. Apart from that, not much has really changed pre-COVID and post-COVID. Good, smart entrepreneurs will continue to win, and COVID only proved that you throw them in any kind of challenge and they'll come out on top.
Okay, understood. Binu, if I may have one more question related to your business. So, as we understand, Freeport is based out of London and has presence across Europe. So specifically, staying on our topic of commercial, mall, real estate and all, is there anything different that happened in the Europe region versus India in terms of rental negotiations, how the retail businesses negotiated with landlords, the mall owners? Anything different that you see in Freeport in Europe regions like, say, UK, France, etc., versus India?
You mean to say COVID, post-COVID, or in general?
Basically, COVID, post-COVID.
In general, there is a lot of difference between the way mall business is handled in India and when my UK counterparts talks to me, is most of the malls in America and outlet malls I'm talking about are not FAR driven. They are only on a single floor, wherein we have these FAR constraints and mall tends to go up. And so we have to consume those FAR and load those rentals on the ground floor because Freeport does not approve more than 2 floors. So my rentals goes high, which is not conducive for brands. But there, it seems the developer has understood this business very well. And the rentals are very friendly. And so we normally are struggling there. Then number 2 is there is less of starter sales happening there, wherein the most starter sales happen in India.
Okay, understood. Okay, thank you very much to Benu, Vikram and Arpit. Now I will if audience has any questions from our panel members, from our speakers, so please feel free to ask. Any questions, anyone? Please raise your hand.
May I ask a question to Vikram? Sure. Yeah. So Vikram, why are we not interested in investing, and you also, Arpit, in real estate and only in technology?
So that's so we invest in asset-light models. And why we invest in asset-light models is typically, we are a fund with a defined life, right? So we invest typically with a 5 to 6 year kind of an exit time frame. And when we are investing with that kind of a time frame in mind, we typically invest in less capital intensive businesses so that, these businesses can scale in that time frame. And typically we look for about 10x kind of a outcome in a 5-year kind of a time frame, which you've done. In Purple, we had an exit in 5 years of 22x, for example. we put 15 crores and we got an exit of 330 crores. So that's the kind of, we just sold Clovia, for example, to Reliance. We had invested 15 crores, we got 160 crores as an exit in Fund 1. And Fund 2 also, we got a substantial outcome there as well. So those kind of exits are very hard to get when you actually invest in real estate, hard assets.
I'll tell you from my experience, I joined the Great India Place when the rentals were 120 per square feet on the ground floor. After 5 years, the same shop, I had leased it out for 450 rupees per square feet. So if we get support like you, funds, we can perform that way.
No, I'm sure there are lots of synergies that you can structure the transactions in such a way. So it's not that we will not look at these transactions. We will. But there may be a way to structure the transaction in such a way that you're actually leveraging, instead of putting on the balance sheet, can you put it on the operating side?
I
You-
hope we do it.
Yeah.
You mentioned about that prop tech fund that you'll be launching, at least related.
Looking forward to that.
Yeah, it's just, we've actually, this is just something we have not, formally announced yet. It's in collaboration with one of the real estate developers, where a set of other real estate developers are pooling in capital with the idea to identify technology applications in real estate. So that is the idea. So which is actually an interesting way to look at it.
Understood. I think we are, the time is up also for our session, but still, if any question from the speakers, please let us know. Okay, none, we guess. Thank you very much.